Since January 2024, we have recalibrated our portfolio and improved execution. The early results are encouraging as we have delivered stronger returns for 2 consecutive years despite a very challenging macro environment. We have worked diligently to reshape our portfolio with targeted investments and divestment actions, create value in our portfolio companies, and strengthen our public market investment capabilities. Our structure has changed, but we continue to operate as one Temasek. Our success depends on the capabilities of each group as well as on reinforcing synergies across the groups. Temasek Singapore stewards our Singapore-based portfolio companies. Temasek Global Investments invests in market leaders globally. Temasek Partnership Solutions scale our capital through partnerships, including Sovera. Temasek International houses our group and corporate functions and support these 3 entities. The refreshed structure sharpens focus and decision-making, strengthens accountability, and keeps strategy and execution closely aligned. We are focused on portfolio construction for resilience and sustainable long-term returns rather than prediction. It is also important that we maintain a strong balance sheet and access to liquidity.
The 3 areas that are particularly attractive to us in the current environment and where we are looking to increase our exposure. The first, not surprisingly, is AI, which is a structural, long-term driver of value creation. Here we're looking to deploy across the entire value chain, from energy and data center infrastructure to semiconductors, cloud platforms, models, and applications. Our exposure here is currently 6% of our portfolio, and we're looking to increase it to up to 15% by 2031. The second area is core plus infrastructure. Apart from data-centered, AI-driven infrastructure demand, there is also rising electrification across sectors, and together it underpins a compelling investment case. The demand for capital in these segments is so strong that we expect it will give us private equity-like returns over the next few years with lower risk. Again, it's a small part of our portfolio today, just about 1%, but we aim to scale it to 5% by 2031. The third area is private credit. In an environment of higher inflation and interest rates, we think it should give us over 10% returns. This asset also has high cash yields and tends to outperform private equity in uncertain environments. We consolidated all our private credit activities under Aranda, which today has more than a $13 billion portfolio. Again, from 2% of our portfolio today, we aim to grow private credit to 5% by 2031. So together, these 3 areas are targeted to account for around 25% of our portfolio by 2031, up from just around 10% today. The rest of the portfolio remains anchored in the businesses and sectors that have delivered for us over decades. These are companies with strong competitive positions in their markets, global leaders with pricing power through cycles, and sectors aligned with long-term structural trends. We're in an environment of heightened uncertainty today because of geopolitics, AI, climate change, inflation. It's important for us, therefore, to construct a portfolio that will be resilient across different environments. We do that in a few ways. Geopolitical risks are addressed through geographic diversification, but more importantly, a focus on businesses that have access to large domestic markets with resilient supply chains. We see these qualities in our key markets of the US, Europe, China, and India, where markets domestically are large, but also businesses we target like healthcare services in India and consumer brands in China, they aren't directly impacted by geopolitics. Secondly, liquidity, that's an important source of resilience. While we are very comfortable with the high proportion of private and illiquid assets in our portfolio, in fact, they've given us higher returns over longer periods, we have 25% of our portfolio in liquid public equities. It gives us the flexibility to respond to changes in the environment and pivot our portfolio to take advantage of new trends.
We remain mindful of the implications of inflation, higher for longer interest rates, leverage, structural headwinds, and valuations. This is our stance: portfolio resilience, strategic relevance, and disciplined deployment.